I'd like to welcome Ed Lazear. Ed, I always look forward to talking to you after all the big employment reports. And this one, in so many ways, was big real quickly. Up 0.2 on both employment to population and labor force participation rate. I always think those are super important. We're drawing people back. We forgot or have stopped counting. Wages was strong. Give me your impression, Ed.
Great. Well, I'm glad you said we're drawing people back, because I think that's the most important point. If you think back a couple of years ago, people were saying, oh, this is a structural problem in the labor market. There's no way we're going to get these people in here. That was just wrong. They were 180 degrees off, and in fact, we're seeing that now. So you mentioned the employment to population ratio. It's up to, it's high actually since the recession. And I would say we've got a little bit more room to go on that, but not much. We're getting pretty close to the peak. It's looking pretty good. Still a bit more room. And the way we know there's more room, again, is something that you and I have talked about a lot in the past, and that is that if you look at job creation and you look at that relative to the number of jobs necessary to keep up with population growth, we're still considerably above that. The last 3-month average, which is what I always look at, was 218. Population growth, you need somewhere in the 130s. So we're still, we're still in recovery mode. It's pretty hard to believe, but we are still recovering. And that's actually good news, because it means that the economy is still on a strong, positive track. The obvious thing that you talked about earlier, I listened to you this morning, was the wage issue. And of course, everybody is both excited and perhaps a little bit concerned about that. I'm not concerned, and I'll tell you why I'm not concerned. To me, the most important thing that you want to think about when you're looking at wages is what's happened to productivity. If you look at productivity over the past 6 months, productivity has jumped up to now slightly above 2.5% from a number like 1.2% during the recovery. So we're considerably up from where we were. And productivity maps directly into wage growth later on. So that's really good news. It's not surprising that wages are growing. They're reflecting the growing productivity. Workers are getting their share of it.
The big question really is, let's cut through it all. There are many smart people out there like Lacey Hunt who really monitor a lot of the same smoke signals the Fed monitors to see inflation. And even though some of them, all of them actually, are elevated, the question is, will they really push through the envelope and start spilling into the economy at large? Now, just because wage pressures are forming doesn't mean that transmission is going to occur anytime soon. And that's a hard issue to grasp for many investors, so they just get trigger happy on the wage numbers. Can you divine that a little bit for me, Ed?
Absolutely. And again, the easiest way to think about it is this. Wage growth that matches productivity growth is not inflationary. The reason is this: if output is growing and wages are growing by the same amount, you're not putting upward pressure on prices, because you have the output there to match the wage growth that's going on. So the question then would be, when should the Fed be alarmed? Now, the Fed has this notion of a target rate of about 2%. Whether you like that or not, that's their target rate. So if you said, well, 2% added to 2.5% productivity growth, we would be then saying, gee, we could afford 4.5% wage growth and still not be putting upward pressure on prices beyond that which the Fed would allow. So that's how I think about it. As long as we're within that range, we're still not seeing upward inflationary pressure. Now, I want to come back to something that you talked about earlier, Rick, because I know that you do believe in the Fed's approach to normalizing interest rates, and that, I think, is an important point. So they are on a trajectory to do that, but the reason for doing that, I would argue, has nothing to do with wage inflation. It's simply to get back to normal times and to normal interest rates of the kind that we saw historically.
I call it insurance, and I couldn't agree with you more. In my mind, previous Fed chairman or chairwomen, they waited too long, and I understand why they waited too long. They didn't want their fingerprints on a reversal of stimulus before they thought the economy was really hitting the ground with its legs moving. The problem with that notion is I think we've fallen behind. So you could talk about data dependent, you could talk about a lot of issues, but the idea that we are now in a range of over 2%, where other economies, big ones in Europe and Japan, are in the infancies of true normalization. I think it's a price worth paying if they've maybe snugged up a little too quick in a short time frame. Tell me what you think happens. Should we get a surprise recession in the next 18 months, which I don't think we will? How does Mario Draghi and Kuroda in Japan deal with those issues? Where do they get the stimulus to jumpstart an economy that's still loaded with stimulus from the last crisis?
Right. Well, it's a couple of things. It's just the point that you just made about the stimulus. But beyond that is, something that I know you focus on a lot, which is capital flows. And the capital flows are affected by those different interest rates between the major economies, obviously ours and the European and Japanese economies. And so, we're sucking in money right now because our real interest rate is higher than their interest rate. And that is not going to be good for their economy, particularly if they hit some soft spots. So that's a concern. If I were in their shoes, that would be a concern that I had as well. And I would be thinking about trying to get on a more normal path pretty quickly.